Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we've got FuturesTrader71 back for another great webinar. This is part of our 4-year anniversary. We actually have 16 webinars all throughout the month of June. And during each of those webinars, we're giving away some fantastic prizes. In this webinar, we're giving away 10 autographed copies of a book that FT selected, which is called The Power of Habit. And so stay tuned to the end of the presentation, and we will be asking some quiz questions, which is based on the content covered by FT today, and then awarding those prizes. Today, FT is going to talk about statistical analysis for a broader edge, and some of the bullet points include key distinctions for professional traders, using basic instrument data to form a general expectation, defining an assumption and verifying it through statistics, statistical behavioral expectation, the entire process using an example, and then how to trade using this information. As always, the webinar will be recorded. I'll post the recording on YouTube sometime tomorrow and on BMT. If you guys are watching the recording at a later date, do me a favor and give us a thumbs up on YouTube or fill out the feedback form on BMT. There will be a Q&A at the end of the presentation. Okay, guys, give me 1 second, and I'll turn things over to FT. All right, FT, you should have control.
Yes, I do, and thanks for the intro, and thanks for inviting me on. Let's see if you can see the screen. Looks like you can see the screen. All right, I want to start off with a regulatory requirement. I need to read this risk disclaimer out to you. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss. It is not suitable for all investors. Opinions, market data, and recommendations are subject to change at any time. So, like Mike was talking about, I wanted to go over the aspect of research. Like when somebody says, hey, you should do your homework, what should that entail? I'm not going to get into too much depth of the process of reading the market in context and figuring out areas to trade for the next day or for the current session or whatever. I'm going to look at the specifics of just trying to find an edge or finding an edge by pulling data from your charting package or from the market and then applying some studies to it. So all there is in trading is execution. Execution is trading. Execution is where the rubber meets the road. So execution to me is a culmination of your homework, research, whatever you want to call it, your attitude, and the prep, including what software to use, which broker to use, and all that stuff, what services. That's all part of your prep. And it all comes down to the click. The click is then, once you click, the trade is out on the market. And if you're not someone who interferes with his or her trades, then the market determines the outcome of that click. The key distinction in how professionals think and how others think about trading comes down to several things. The understanding of how the market works. Instead of looking at the market as a bunch of numbers and blinking lights and so forth on your dome, you should look at, in my opinion, you should look at what makes the market tick up or down. What causes prices to travel up? What stops them? Why do they move down? These are important things. The simplest explanation for a market upticking in price, for somebody actually being motivated enough at the high of the year or the high of the last 5 years to reach to the next highest price and buy it, is a belief that it should go even higher. The opposite for someone selling the market. They believe that they should sell the market or hit the bid because they believe that it should move lower by at least a few ticks so that they can secure some profits. That's at the rawest, in its rawest form, that is what makes the market uptick and downtick. Why is this important? It's because we want to understand that it takes one person, it takes one trader to cause that uptick or downtick and to change the outcome of your trade. That one tick can trigger stops at the very high, which can then trigger your stop. So every participant out there can influence the outcome of a trade. That's one thing that a professional knows or has experienced versus others who just kind of look at the market as a bunch of different prices. So understanding that is very important. What makes a rising market stop and turn? A market is a mechanism for advertising prices. In its purest form, that's all it is. It's just checking to find as many participants as possible to trade at whatever price they can agree on. The market's indifferent to what that price is. So as the market moves up, it's advertising for sellers to come into the market. It's asking, the price has just moved up. Are you motivated now? No? Okay, we'll move up a little more. Are you motivated now? No. And it'll keep doing that until it finds motivated sellers. And those sellers could be those who bought and are holding long and now become sellers, or it could be what I call the third force, or the people on the sideline. The people on the sideline, the third force, are the unknown. They're the highest influence in the market because there's a potentially an infinite amount of money that's sitting on the side that's waiting to act. The only people we can measure are the people who are committed already. So we see their volume, and that's why I use volume profiling. What is the point of market movement? It's just that. It is to get as many buyers and sellers to agree on a price and transact at that price. Okay, and that's the high volume node or the point of control on a profile chart. Do we need more than price and volume to get an edge? That's up to you to determine, but again, as a professional, you know that all there is a derivative of price and volume. There isn't much more. So the use of a footprint or the use of an average or an RSI or CCI or whatever is just a derivation of price and volume. So in your research, or at least in my research, I'm looking at price and volume. I'm breaking everything down to its lowest possible form, and that is price and volume. And the example I'm going to show you of doing a statistical study is just that. It's just bringing price and volume in and applying just simple Excel studies to it, simple Excel formulae to it, to extract an edge. And we'll talk about that. Are statistics the absolute key to consistent trading? Absolutely not, in my opinion. What we're going to talk about is just finding an edge through statistics, but I want to remind you that there are three things that, in my opinion, make a consistent professional trader different than someone who's struggling. The three things are discipline, first and foremost. Without discipline, it's really hard, in my opinion, to get anywhere with anything. The second is thinking in probabilities, and this is where this is what this webinar is about, is thinking in probabilities, at least in a small, short format. There's a lot more to it than what we'll talk about today, but this is a good start. The last thing that just makes a distinction between a professional and everyone else, a consistent professional and everyone else, is knowing that they don't know. I know as a trader, once I get into a trade, even if, and I'll show you an example, a live example, statistical example, where the probability is extremely high, yet when I take this trade based on this probability, I know without a doubt, and the market has proven to me over and over and over, that I don't know the outcome. I just don't know. And the trap that a lot of people fall into is only putting a trade when they think they know and they've eliminated any possibility of the trade being a failure. So it takes them forever to get up, to get the courage to actually click. Once they click, they will not accept any adverse behavior. They will not accept a loss. They will move their stop, or they'll get out quickly, or whatever. The fact is, I know that I don't know what the outcome of this trade is going to be. So 3 things that make a professional different than most others. Again, discipline, thinking in probabilities, which is what this webinar is about, and knowing that you don't know. Okay. The last thing I want to discuss here with this slide is how much is enough. So one thing I'm seeing through our traders, through my brokerage and so forth, is that there's just an awful lot of attention paid to being precise and extracting as much knowledge and information as you can from the market. That sounds good in a theoretical environment like a university or something, but in the real world, as you already know through your job or through your work experience, the bulk of what you need to know is fairly, comes out of common sense, and going out and doing studies on tick data, for example, when you're someone who's trading on a 15-minute or 30-minute chart, is a whole lot of effort for very little return. You might be able to refine a probability for a 2-year data set from, say, 73.2%, and after 16 hours of study and refinement, you might find it went from 73.2% to 76.8%. Does it make a difference as a trader? It does not. It does not. Practically, it does not. So don't get too caught up in being an Excel guru or coding in R or MATLAB or whatever. You'll end up making that your job rather than trading. Okay? So let's move on to the next slide. So here's what we're going to cover. I'm going to extract bar data from my trading chart. Before I extract that bar data, I have to point out that it's really important to extract data in the time frame. So if you're exporting data, it's really important to export the data in the time frame that you're trading in. So always study the data in your relevant time frame. For example, I can go out and pull daily data and do a study that determines the probability of some event happening over several days, okay, and spend all of my time on that particular study. But if I'm a scalper, that's not going to help me too much. It's going to help me a little bit, but in the context of the time frame that I'm trading, it really doesn't affect me that on a Friday when the market closes below mid, but then it opens higher than the mid, and the Thursday was an up day, then Tuesday is more likely to be a down day than an up day. Fantastic, fantastic news. But that's not going to help you if you can't get yourself to hold a trade for more than a few minutes. So don't get lost in the data. Okay. So again, why is the time frame for your exported data important? It is because you want to study what is relevant to your trading style. Okay. We're gonna define a question, which is very important, because if you don't, you'll find yourself finding interesting tidbits as you go through the data and then getting lost and forgetting why you even started Excel. Oops. Getting lost and forgetting why you started Excel and why you're doing the study. Okay, and that's not very useful either. So we want to define a clear question. So the first element we want to look at when we're doing this is to define a clear question. Verifying this assumption through statistics. So we're going to go through all kinds of numbers and so forth, and we're going to check to see if that what the result of that assumption is, or what the answer to that question is. The next thing we're going to do is look at averages and other misleading metrics. So I'm not going to cover that with a live example, but I'm going to show you some profile charts that show you how data in real life is distributed versus how they are theoretically. and why averages are misleading. Using an average to study data in trading is very, very common. I don't rely on averages because I know that they're not descriptive. So an average would be great if the data is distributed normally. In other words, it has a nice bell curve, bell shape to it. So in order to define what's normal, I'm showing you examples here of a normal distribution. Beautiful. As the data moves away from the middle, it tapers off. The instances of that data, or the frequency of that data, tapers off with a peak in the middle, and it tapers off on the other side. This is one standard deviation. Okay. What is considered normal? This is the normal distribution. But what is statistically normal about this distribution? Statistically, when somebody speaks about the normal behavior of a crowd or a population of data, they're speaking about what represents 68%, or the first standard deviation of that crowd, okay? So you can see it here. This is one standard deviation. Anything that occurs within this blue area is considered normal. So if I plotted, for all the participants that are in here, if I plotted the distribution of the age distribution of our participants, and it happened to fall into this curve, then if I find out what 68% from the center is in the shape, that is what's considered the normal age of this group. Okay, so normal in statistics describes 68% or one standard deviation. Okay, when you hear of a 6 sigma event, essentially one standard deviation is a sigma. This is 2 sigma, which represents 95.45%. 3 sigma, 99.73. 4 sigma is 99.994. 5 sigma is 99.99996, and so on. So a 6 sigma event is something that happens almost never. Okay, so a black swan event is a 6 sigma event, for example, and it just doesn't happen very often. Just to put things in statistically, just to kind of give you a refresher on that. Statistical behavioral expectations, we'll discuss that a little bit once I have the data that I'm going to extract. We're going to talk about what is an edge really, and let's just dig into the example because I'm sure everybody's dying to see that. So the first thing I did, here's my charting package, my charting software. I keep a chart that I call ES Research Chart. What I'm doing is I'm creating a question that I want to answer. And so let's look at the question. The question is that I'm defining here is, how often does the day session equal or exceed the overnight low or high in the ES? That's my question. Okay, so now I got to go through the process of figuring out how I'm going to do that. So the first thing I do is I bring in a chart that only shows me the overnight data because that's what I'm testing. So this is going to be different for everybody. This is Investor RT. It's my favorite charting tool. You can just email me or go to my website to drop me a question on it. I have a session set up for overnight data only. Okay, it's session 33. So what I've done is I pulled daily bars. So the time frame right here is day. And now what this charting package has done is it's pulled in the data just for the day, but for the overnight session. So it starts at 3:30 Central, and it goes to 8:29 a.m. the next day. Okay, I'm going to export this data, export instrument data, and go through the process of exporting it. Once I've exported that data into Excel, then I come back and I switch the session to day session data. Starts at 8:30 a.m. Central or 4:30 or 9:30 Eastern, and it goes to 3:15 Central or 4:15 Eastern. Okay, so hit OK. It pulls in that data. Here we go. So these are day session bars only. Okay, and then I will export that into Excel. Okay, so I've done that already, kind of like those cooking shows where they prepare the meal before the show. I've done that already, and that data is right here. So the night data, night session data is right here. Let me highlight that. And the day session data is right here. And I've matched, the first thing I got to check is to make sure that I'm matching the dates. I'd hate to import the 11th when it's the 10th. This data goes back to 2005. Let's copy and paste or cut and paste our question to keep that in perspective. So that's the question we're looking to answer. We're comparing the day session versus the overnight session. How often does the day session take out the overnight session? The first thing I got to do is check for matching days. Okay? If you do not use Excel, if you're confused by all of this, just sit tight. This is useful anyway. This helps you see, in my opinion, this will help you see what what other traders are doing to get their edge. Okay? So all I'm going to do is say, all right, compare this date to this date. And if it comes back, oh, yes, compare this day, which is the 10th, to the 10th here. All I'm interested in is that the two sessions are the same. True. I'm going to double-click the little square to copy that down. As long as it says true, I know that I'm comparing the 2 days to each other. Okay, true, 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 true. If they don't match, what you have to do is go to the overnight session and delete that entire line of data and make sure that the rows match each other. So I run through my data, and it looks like every day, just like in those cooking shows, every day matches perfectly. Great. The next thing I want to ask, hang on. Just bear with me a second here. The next thing I want to ask is, if the high is broken. So the next thing I want to ask is the high broken? So I create a column, and I'm looking at whether or not the high of the day session is greater than or equal to the high of the night session. It's not in this instance. So check your math. The day session high is 2175. The night session high is 1225 even. So it's false. The high here didn't break the overnight session, so that's false. So that looks good. I'm going to copy that down by double-clicking and spot check another piece of data. This is saying that the day high of 1210.50 exceeded the night high of 1207.25. That is true. So now I know that that formula is correct. Now I'm going to check if the low is broken. Okay? Same thing. Is the low less than or equal to this low? So the low here is 1210, the low here is 1219.75, so the day session broke the night session low. Okay? And I'll put this in perspective for you. You're probably wondering, why the heck are you looking at this? Now I'm going to check to see if both high and low are broken. So I want to know how often that happens. All I have to do is say, all right, give me an instance where this is equal true and this is equal true. Again, there are plenty of Excel, YouTube videos, and all that stuff. So all this formula does, it says, I'll tell you that it's true only if the high is broken and the low is broken. If that's the case, then I'll tell you true. If only one of them is broken, I'm going to say it's false. Like you see here, false, true, so false, true, 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 false, true, false. Okay? And then finally, I'm going to check whether the high or low is broken. High or low. For that, I'll say or this is equal true, or this is equal true. Just one of those to be true. Boom. The study is pretty much complete. So now I'm going to look at the statistics. First, I want to know what my sample is. So the total sample size, how many days did I bring in? Count the number of days I brought in. I'm testing 1,974 samples. Anything above 250 samples is sufficient to come up with a decent trading conclusion, okay, in my opinion. I have 1974. The first question I want to ask is, how often is the high broken? So I'm going to ask it to count if this column is true. So let me show you that formula. I'm basically saying count anything that is true. Count how many times you see the word true in this column. Okay? And it says out of this whole column, the high was broken 1,250 times. So now I want a percentage of the total sample. 63%. What this is saying is for this data, 63% the high was broken during the day that was put in overnight. How about how often the low was broken? Equals count if this column, which is the low broken column, equals true. Again, I'm going to show you the formula. So now go to the low broken column, check all of it, and tell me, count any time if there is a true, give me that number. Okay? We take that, divided by the total sample, 63%, or 60%. 60% of the time, the low is broken. Okay? Now, I want to know how often both are broken. So, same thing, count if both column is true. That occurs, the last time I did this, it was 27%. Oh, it still is. 28%. Okay? Now, the question, though, how often does the day session equal or exceed the overnight low or the high in the ES? How often do we break when we open? So the overnight high and low were put in. How often during the day, at some point in the day session, remember I pulled in daily bars, so at any point in the day session, how often the high or the low were broken? Man, I'm sounding like my college professor. It bothers me. So now I'm testing for basically what this question is asking, probability of high or low broken during day. Let's expand on it. Overnight high or low broken. Okay, for that I'll say count if this column is true. Oh, sorry, misspelling. Let me fix that. Bam. So, I'm sure there are some really smart guys here who do some quick math and can see that that's a very high number. There. 96% of the time, the high or the low in the ES is broken during the day session that was put in overnight. Okay, just to verify our data, I pulled in everything including yesterday, 6/10/2013 overnight, 6/10/2013 during the day, and I went back to 10/10/2005. Okay, about 3.5, 7.5 years. 96% of the time for this data set in the ES will break the high or the low put in overnight, 96% of the time. That's a pretty high probability, right? That's useful information. Can I create a trading system based on that piece of information? Absolutely not, because having 96% probability without a defined risk, without some sort of an entry plan, but the key thing being the risk and an entry comes next. You could have a 96% probability of an event happening but end up losing money anyway because you make 2 ticks when it works and you're losing 16 points when it isn't, right? And so that's the bottom line. So we've successfully answered that question. We can take that question off, 96%. Okay. Now, if you're a data whiz, what you would do is you would hone it down a little bit more. So one thing I want to find out is, for example, so I can expand on this, I want to find out what the range is overnight. The range is the high and the low, subtracted from each other. So these are the ES ranges overnight. And what we could do is determine when, under what circumstances it's more likely not to occur. Actually, I don't need the day range, but so if I take and filter this data, hang on, I'm going to if I take and filter this data, so I'll start the data filter here, and I filter for false, and look at what was the overnight range that caused neither the high or the low to break, and then I can create a distribution of that, and that's where averages fall flat on their face. So let me reduce this. Can you guys see this still clearly with the smaller font? Let's see, where are your answers? Okay, cool. So now I've got these ranges. I've got a situation where I filtered out right here when the high or the low was not broken. Okay. Now I can take this data, this is the overnight data, copy it into a separate sheet. So this is overnight range. These are the ranges for those days where the high or the low was not broken. And what I want to do is find out how often does this range occur. So what I'm trying to determine, I'm trying to hone in on that 96% and find out what conditions might cause the overnight high or low not to be broken. So what I want to see in this situation is what is the normal range of it breaking, of it not breaking, and what is the extended range of it not breaking. So I can run a simple statistic. So let's find out basic metrics, max. So I'm looking for the max size overnight range that we've had, 82 points. Remember, this went through the 2008 crash and so forth. The minimum size, I don't really care about the minimum really. 2.75, I'll put it on here just for consistency, equals min. Sure, I'm putting some of you to sleep. The average equals average of this information. So the average range is 18.46. But what I really want to find out is the distribution of this. And I'll tell you why. When you look at the market hardly ever fits a normal distribution. So this chart here shows the profiles of the profiles of the daily action, the daily profile and volume, okay? And you can see here there are days that have somewhat of a normal distribution, kind of, okay? But most of the time the market trades on what is called a skew, okay? The data is skewed to one side or the other. And you can do this with how many blondes there are in a population of people, how many students there are of different ages in an airport, whatever you want to study, it doesn't matter. It hardly ever falls into the normal distribution that you would see. It's often skewed to one side or the other. When I do an average, it is an approximation of the average value within that population, but it does not define where that population really occurred in a skew. So if you were to look up, for example, I'll show you here. If you were to look up just a normal statistic, you'll see that a lot of data is skewed to the right, skewed to the left, or just flat all around. Hardly anything fits into a bell curve. And that is why I don't use averages, because averages are not descriptive of that distribution. Okay? So in our example, I want to find out what this data looks like. So I'm going to create what's called a histogram, the same thing as you saw on this image here, but I'm going to create it in Excel with the range of the overnight session that that caused the high or the low to not be exceeded. So I want to see where that falls. And to create that, I'll go in half-point increments. So 4.0. Again, the idea here is not to give you answers. The idea here is to help you find those answers. So the highest value is 80. So my data goes, the highest value is 82, but that doesn't matter because we're not going to use this data. It's what's called a tail. So it's going to fall well out of what is considered normal. And then I'm going to use the histogram function in Excel to pull that data into a nice, neat chart. I'm binning, or I'm organizing the data into these numbers which I've created. The output goes right here. And so now this is telling me how often a certain number or range occurs. Let's make it nice and colorful for you. So when you look at this data, you'll see it's chunky, and a lot of it is on this end. Okay, so what this is saying is when the situation was when the overnight high and the overnight low didn't break, more often than not, it occurred in this end of the range versus this end of the range, the smaller. So if I looked at this as a whole, you'll see that most of the data occurs in the low end of the range, which is counterintuitive because you would think that if we don't break the overnight high or low, it's got to be the bigger ranges. If we have a 72-point range overnight, it's probably not going to break it. But the fact is, I don't have enough data here to make a complete statistical analysis because I have 82 false occurrences. That's not enough to come up with a true statistical definition or a reliable answer. So I would need to pull in a lot more data of the false occurring. But what this is saying is you would think that the range would have to be really big for neither the overnight high nor the low to be broken. But actually, it occurs across the board. It occurs more on the low end of the range than it does on these crazy, ridiculous ranges. So the 96% probability in this situation cannot be refined using the range, the overnight range. So even though the overnight range may have been 7 points, you can't be gung-ho about the fact that the high or the low will be broken every single time. Because it can, even though it might have a 5-point range or whatever, you may end up with a higher low that didn't get broken. One thing I didn't do to this data, which needs to be done, is I did not filter out holidays. I'll give you an example. 220, 219, 219. Those are holidays. Days that I can remove which don't represent, tradable days. 7-3, which is the day before the 4th of July. 9-8, which is the day right after Labor Day. Things like that, or that could be actually Labor Day. Things like that. So I can remove those to refine my data better. But the fact is, in the end, at the bottom of this whole thing, we got a probability that the overnight high or low are broken 96% of the time. And here's the other one. Let's say you cannot find a way to enter to take advantage of that edge. Okay. Another important edge is right here. 28%. 28%. What is this statistic saying? Let's see some guesses. What is this statistic saying, and how can you take advantage of it? Anybody? Come on, wake up. Inside day. No, this is saying 28% of the time both the overnight high and the overnight low are broken. It's got to be telling you something. Yes. So you can glean an edge from that. And the edge from that day is, so the market opens, it breaks the overnight high. The market opens and breaks the overnight high. The overnight high is broken. The 96% probability, poof, gone. Is there still an edge to the study? The edge is 72% of the time it will not break the other side. 72% of the time, which is 100% minus, is that a tradable edge? You bet your behind it is. That is a tradable edge. What it's saying is if you break the overnight low during the day session after the U.S. opens, okay, the probability of it breaking the other side is 28%. So if you come in and you get a short on, or you're looking to stock or trade a short, and that short trade, and let's say you're a 2-day trader, not just an intraday, but a 2-day trader, let's say, you're going to hold the position overnight. If you get short and the market happens to break the overnight low, there's a 28% probability that it's going to break the overnight high. So your stop might be placed higher than the overnight high, because 72% of the time that stop will likely not get triggered. That's an edge in itself, that's 72%. So that's what you can do with statistics. And that's a simple, simple edge. You can design a trading system around this if you can define risk. And defining risk and entry is a matter of context, and that's what I want to talk about next. Are there any questions specific to extracting this sort of a statistical edge? This is a big picture edge, but you can do this on many, many, many levels. You can do this by studying the probability of, what is a normal range. We can look and study what is a normal range in the ES, and then once you know what a normal range is, which represents 68% of the data. So let's do that. What is the normal range for a day session? Okay, then we can take and create, so 1.25 to 56. So for this particular data set, the high, the max is, what is it, 56.25. The min, let's call it 2. The min is 2. So I can create a bin that goes from 2, and let's do it in a, let's make it a raw, let's just go in points. I'll do it in points just to keep things concise. Wait, the data's filtered. Hang on, that's why it's doing that. So 2, 3, 4. And let's go to 57, and then we can pull in really quickly. We can pull in what the distribution of that data is. High minus low. Okay. So, voila. The bin is right here, and then I want to create the output and put it right here. Okay, so here's the frequency of how those days are distributed. I like to color it in so I can get a visual of it. So you see how the data is skewed? Okay. The data is skewed. It's telling me that the most common range for the ES is in a 1 point increment. The most common range is 10. The next most common range is 11. The common range that is most common after that is 12, 13. Then we have 8. So I'm going to find out what the normal is, which is, so we have a sample size of 1974. So the first standard deviation, or what is normal? Normal is 68% of that sample. 68%. And then I'm going to select what 68% is from the data set and show you what is normal in the ES. So I'm going to go and select all the higher prices. That. Oh, hang on. So where was I? So right here is normal. So I want the normal distribution requires 38 samples or 39 samples, let's say. And I've selected 37 of those samples. So right here is what's considered normal. So what this is saying, on a very crude basis, this study can be done to the tick. On a very crude basis, this is considered normal. Normal range for the ES during the day session is 8 points to 12 points. That's what we should expect. Okay. I don't remember where I was going with this, but anyway, that's another study that shows. So yeah, I wanted to look at this and compare it to average. So equals average. What is the average here? The average is 10.625, so it's very close to what we would consider to be the most common, which is 10. Okay, in this situation, because I'm using crude numbers, it comes pretty close, closer to 11 than 10, but it's pretty close. The average is taken into account how much of a certain data set occurs, like it takes the number of samples by where it occurs, and it comes up with a number. However, 10.625 is not normal. That's not the normal range, and that's the point here. The normal range is 8 to 12, whereas if you just take the average, you think it's 10.6 or 10.5 points. But actually, everything from about 8 till about 12 is normal. But the average does not describe that. Okay? So that answers the question that I had brought up earlier regarding the looking at averages and other misleading metrics. Having an average is not descriptive enough. In my opinion, for you as a trader, having an average is not descriptive enough to come up with a high confidence conclusion. Okay. The other thing you must remember is the statistical behavior expectations. So one thing I've talked about with Big Mike in the past and has drummed up a lot of conversation on several threads is even though my statistical study here shows that there's a 96% probability of something happening, the fact is if I blindly come in tomorrow and flip a coin and get long or short, get stopped, flip a coin again or get long or short, I get stopped, and I take a trade in the opposite direction and put my stop outside of the overnight high or low, it still does not tell me that I'm going to win every time. The fact is, the very next time I trade this 96% probability, I could still lose. So my point with talking about statistical behavioral expectation is you can't assume that because you have such a high probability that the outcome of this next trade is going to be 96%. The outcome of this very next trade is win or lose, win or lose. Doesn't matter if it's 99% probability of this occurring. If I traded 1,974 times, 1,974 days, there is no way for me to know when that trade is going to hit and when it's not. Okay, and so that's very important to know about statistical systems. You know, as I always say, past performance is not indicative of future results and so forth. It's because all those results that you're being given are statistical in nature, and they just do not describe what might happen to a trade when it actually goes off. And so you have to remember that even though you've done this homework, even though you've honed it to the point where it's 96% like we just did here live, it still doesn't mean that you should just forget about risk, mortgage your house, and trade the biggest size possible going for that 96% probability. You still have to contend with the fact that you have to define your risk. You will lose despite the 96% probability. It's just the way the market works. But you just have to put it in perspective. Okay? What was I going to talk about next? An edge. Can you describe to me what does it mean? What does that mean, an edge? What is an edge? A very short description of what an edge is. Actually, we're going to ask that question later for a prize. Why don't you save your answer? You have to understand what an edge is. Is 50.5% an edge? is 50.02% an edge. The other thing about going back to statistical behavior that I wanted you to remember is the study we just did is based on a defined, finite data set. It's historic. Okay? This number is ever fluctuating every day. Every day. It's fluctuating. Okay? And so you can't base your decision simply on an edge for a given data set. That's how all those curve-fitted systems that make a ton of money and blah, 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 and it's just all nonsense. Those are all based on taking a set of data and curve-fitting or optimizing for that data. We don't optimize in our research. We just take the data for what it is, and we're just looking for something for what I define as an edge, and that is the probability of one thing occurring over another. Okay. Very simply, that's all it takes. Okay. And if you speak to anybody who's trading size in the market, in the futures market or whatever, and you ask them what is an edge, that's at its simplest. It is that. It is just the probability of one thing happening over another. And that's all there is. And as traders, we just try to take advantage of that. Okay? That's all I had for you. That's all I had as far as the information. I'll leave you with one last thought. If, despite the amount of work you can do with spreadsheets and research and so forth, in my experience, and having traded a lot of size, having traded probably tens and tens, if not hundreds of thousands of round turns in the futures, I always put context first. So I can have the best possible study and research and so forth. But if I'm not keeping track of what the overall message of the market is, what it's trying to achieve in the way it trades, if I'm not looking at that, then my statistics have a lower chance of success. For example, if yesterday was a reversal day like this was, and today we gap up and there's a statistic that tells me get short, get short, get short, get short, get short, that's a better probability. I have a huge probability of getting short. The fact that the prior day was a reversal day puts that statistic into context for me. It tells me, fine, statistically, I will get short because that's my plan. But I will bet smaller on that statistic because the context tells me that we had a reversal day, we gapped up, we tried to get down to this range, we couldn't, chances are we're going to finish higher. That's how I read the market, as a story, as an unfolding story. And the statistics are almost like a support mechanism for the story. It gives me a little bit of a comfort level that says, I know the next trade's outcome is either a loss or a win, but I also have a statistic that says 83% probability that this will happen over another, 78% probability that that will happen over this. It gives me a little bit more confidence, but it certainly doesn't define for me what the overall market stance is. You could do research on moving averages when they cross, but just because they crossed and that cross gives you a 76% probability of a continuation day or something in the direction of the cross does not mean that I will disregard risk and bet the farm on that particular statistic because it has a bigger chance of winning versus losing. I just want to bring your attention to the fact that you have to keep things in context. Context is king in trading. Even when you don't understand why a statistic isn't working, keeping track of what the market's trying to do, which participants are winning, is it the buyers or the sellers? How often? Are there areas that they're not able to exceed? Are there double, triple, quadruple tops They have not broken in the past, yet we keep revisiting them. I would bet, I have a study that says that there's an extremely high probability that a double top or a double top becoming a triple top, once it becomes a triple top, there's an extremely high probability that it will break. If it's a quadruple top, it's like ridiculously high. So it's not a level that I would short against just because it held in the past. The more it holds, the more it's likely to break statistically. That's another study that you can do. Anyway, that's all I had, Mike. I've been talking for an hour. I think I've covered pretty much all the material I had.
Okay, so let's open it up for just a few quick questions. If anybody has general Q&A on anything today, and then we'll go to the prizes. All right, okay. Let's see. Bill is asking, statistics aren't trade confirmations, but are there stats that you won't trade against?
Yeah, I'm actually, the stats that I have from my research help me decide I will not trade against certain things. For example, let's say I have an idea. The idea is that, let's throw something out. The idea is if, the question I asked before I do the study is, if a 5-minute bar goes into, if we have a gap up and a 5-minute bar goes into the previous day's range. So let's say we gap up and now I have a 5-minute bar that closes inside of yesterday's range, below yesterday's high, okay? And I think, well, if it does that, then intuitively I think that it would probably continue to sell off because it went into the prior day's range, right? But statistically, that's not the case. So finding out that the edge or that idea failed gives me the confidence in the opposite idea, if that makes sense. So I won't trade against let's say the double top example that I said. If you know, you have a top then a double top, well, the double top now has a higher probability, but it's still low. It has like I think it's like a 63% probability of breaking. But once it becomes a triple top, that shoots up to like 87%. Again, these are old studies. Do your own homework. Don't trade based on that information. I'm just giving you an example. Once it gets to a triple top, that probability becomes really high. Well, knowing that, I will not short. I will not short. But the study, having done the study myself as opposed to relying on someone else's homework, tells me the parameters of the study. Okay, if it breaks and that 83 or 86% probability comes to fruition, does it break by a tick? Because if I did the study so that the double top breaks, if I didn't specify how far, it could break by a tick and fall right back. So yeah, it did happen. The double top became a triple top and it broke, but that might not be a trade that I'll hold on to for very long. I would want to see a break and a continuation. So I will not short a double top or a triple top, but I also have not defined the risk for getting long into it at the same time. So that's where statistics are, again, the statistics are support. It supports your ideas. It doesn't make an idea for what it is. If I gave you a statistic, a raw statistic, to trade off of, you should be asking a lot of questions like, okay, what were the parameters? How often does it hold? Under what circumstances should I create a plan around them? Things like that. So doing statistical research, which a lot of people focus on, they focus 90% of their effort on getting market information, but that's not enough to create a plan. There's still the issues with psychology when it comes to execution. There are also the issues of defining the risk-reward parameters. You might have a statistic that is 96% effective, but if you cannot find an entry that is 4 times the risk, gives you returns 1/4 of the risk or something, then that's not a very good statistic to trade off of. I hope that answers your question.
Yeah, and I think real quick it's important to mention that if you sorry, hang on one second, sorry.
Yeah.
Okay, I've got too much going on. I've got server problems I'm trying to deal with and multitask. I think it's important to point out, though, that even if something happens 99% of the time, if you trade hundreds of times, it's important to understand fully what that 1% means, because if you're risking everything, if you're risking 100 ticks, that 1% is going to come back and get you, right? So a lot of people don't remember that, or don't take that into consideration. That it's like the people that are out there that focus only on win percentage instead of focusing on the total picture of expectancy that includes the risk.
Expectancy. I was about to mention that. It doesn't, just because you have a 99. Think about it this way: if you're playing poker and your hand had a 99% probability, and it's your turn to play, it is not wise to push all of your chips to the middle of the table and go all in. It just isn't, because that 1% has, as any trader who's gotten their butt handed to them, and I have a few times, that 1%, boy, that happens. The 1% probability occurs a lot more than people think, So you have to kind of plan for that.
Right.
Never risk a lot.
Daniel's asking, is there any good resource on how to go into more detail on all this? What would you recommend if people want to take this to the next level?
Honestly, Daniel, I can't refer you to anything. I did these webinars for my website for charity, and I stopped at webinar 4.1, which was a homework webinar, and 4.2 was supposed to get into this kind of detail on how to create a question or assumption and test it using various methods, Excel and so forth. But I started a brokerage, and I never got around to doing that webinar, and I don't know anybody else who's got something like this, although I'm sure many people can help. And this is the kind of thing that we've done a lot in our chat room at the brokerage and so forth, where a lot of our traders have gone from not knowing what the heck to do in Excel and how to create a formula to actually running their own studies. It just takes time. It's one of those things that you just need somebody there to kind of help you along as you're trying to figure it out. But once you do, it's very powerful. I'm a huge advocate of getting your own answers. That's my entire existence online, is about having traders, helping prevent traders as much as I can from just blindly buying systems or ideas or subscribing to signals and things like that. It's just so important to come up with your own ideas, test them, because in testing them you start to learn what their limitations are, and it's as important to know there's a 96% probability of the high or the low overnight to be broken in the day session. It's just as important to know what the limitation of that 96% probability is. So I would, maybe you can drop me an email through my website, FuturesTrader71.com, just like you see on the screen. I'll try to point you to some YouTube web videos, but it all depends on how much Excel you know and how much help you need there. You just need to know how to use a certain tool. That's the first thing.
Right. Okay, so I think we can safely go ahead and move to the prizes. So if it's all right with you, I'm going to take back control.
Yes.
And I'm going to share the PowerPoint. All right. So we have 10 prizes to give away. I'm going to ask for your BMT username if you're one of the winners, so that I can contact you on BMT once the webinar is done, once I solve the failed hard drive at least and bring the site back up.
Okay, we can wrap up pretty quickly here.
Yeah, so FT's going to monitor the questions and be on the lookout for the right answer. If there's a question that has multiple answers, please remember to type the answer on one line. Okay. Let's go ahead and get going. So the prize today, by the way, is FT's going to be autographing the book that he selected, which is The Power of Habit. And let's take a look here. Question 1, name 3 key distinctions between consistent professional traders and struggling traders.
Okay, we got Mike with the answer.
Okay. So just go ahead and tell everybody what the answer is. Read it back.
1 is discipline. 2, thinking and probabilities. 3, knowing what others don't know. Well, not really. Hang on. Knowing that you don't know.
Right. All right, Mike, I need your BMT username, please. Okay.
Man, it's almost like these guys got the questions beforehand.
I was going to say, that was a pretty fast answer. I'm pretty impressed by how that happened. Okay, question 2.
Maybe I made it too obvious.
All right, question 2. What is the first element in studying market data?
Oh, Neil's got it.
All right.
He said the question.
All right. So Neil K, I need your BMT username, please. Okay, give me 1 second.
Looks like a lot of answers that didn't hit for a while until Scott got it next. But that's correct. The first element is actually creating a question, defining a clear question.
Okay. And question 3, why are averages not necessarily representative to market activity?
Excuse Howard Jones.
Okay. Howard, I need your BMT username, please. Okay. Okay. Question 4. What percent of the data set defines what is considered normal in a population? Okay.
Whoa! Oh my God! Wait,
right,
I
guys.
can't see it.
All right, guys, stop.
Okay, we got.
Stop typing.
Okay, so it's COPE.
Okay.
Was the first to throw that up there.
Kopish, I need your BMT username, please.
Holy cow! You guys were actually listening. The answer is 68%. 68.2% is the first standard deviation, and that's what's considered normal.
Right.
Good for you guys.
Question 5, unless trading systematically, what other element is needed with statistics to help improve outcome?
Oh, got it. It's Abdil.
Okay. Abdul, I need your BMT username. And what was the right answer?
The right answer is context. You got to have context with statistics to come up with a trading idea to improve your outcome.
Right. Okay. Waiting for
a
Abdul's.
lot of right answers. Good for you.
Just waiting for his username. Okay. Yeah, these guys are really on the ball today. All right, question 6.
They're fast.
What makes a rising market stop?
Scott, don't see the answer yet.
Okay.
Let's see. Keep trying. You're saying more buyers, but there are no more buyers. For every buyer, there's a seller. This one's got them befuddled.
You guys try.
There it is. Hang on. It's Rex W.
Okay. I'm looking, trying to find him.
Yeah, I'm trying to put win next to those who hit it.
Yeah, I got it. All right, so go ahead and tell us the answer. And Rex, I need your username.
Sellers deciding price is too high. That's correct. That's why it stops rising.
Okay. All right, number 7. What is the purest form of market data?
Okay. Oh, got it. Price and volume.
All right, guys, stop.
Oleg. Oleg. No, I'm sorry. It's Juron. Juron, let me.
Yep, he came in first. Okay.
Yeah, yeah.
All right, I need your BMT username, please, Jaron. Okay. Write that down.
Did I make these too easy?
It's all right. It's all in good fun. Number 8, having a statistical edge is important, but what is more important to remember as a trader?
There are multiple answers. Oh my God. Okay, hang on. I'm trying to stop it from scrolling.
Oh, that's my site alarm.
Are we Periscope down going under?
It's just telling me the site's having problems.
So there are three answers or multiple good answers to this. Having a statistical edge is important, but what is more important to remember as a trader? I'm looking through the answers. I'm sorry, they just fly by so fast. Hang on. Still trying to figure it out. So again, having a statistical edge is important, but what is more important to remember as a trader? The answer I was looking for, I'm not seeing. Still scrolling. There's just must be 100 answers in here. Ah, there it is, Donna. Got it. Donna, the answer she gave was one of the three I was looking for. The answer is the outcome is unknown, and that is the absolute truth. Okay. A lot of you wrote risk, which is correct, but risk is a result of knowing that the outcome is unknown. So you have to define and manage your risk, okay? So Donna, as a trader, you have to remember that.
Need your BMT username, please.
It's funny, somebody posted in the Stage 5 chat room, because the answers are going by so fast, he says, I think HFT are in the pool.
Okay, Donna, still need your username, please. I'm going to move on if I don't get it from you.
Okay, let's see. Who's the next person that had it?
Well, I'll just email her. I still want her to get the prize. I just can't wait for her. All right, so Donna, I'm going to move on. Let's see. Number 9. Why is the time frame of your exported data important?
Oh, Jibin got it.
Okay, Jibin, I need your BMT username. And go ahead and give us the answer.
The answer is study what's in your time frame.
Okay, and there's his username. Still don't have Donna's, but I'll just email, I guess, after the webinar and get that. Okay. Not sure what the deal is there. Come on, Donna, get with the program here.
She doesn't want it.
All right, last one, guys. Number 10. What's the simplest description of what an edge is?
Oh, somebody got it really early.
I think they had it waiting. They knew this was coming.
All right, hang on. I'm trying to find the first one. Matt Ratliff. Matt Ratliff. Edge is the probability of one thing happening over another. That's a winner.
All right, Matt, need your username, please. Okay, yeah, I think that they used some reasoning there to find out that one was coming, since it hadn't shown up yet and you mentioned it, so that's fine. It's all in good fun, right?
Yeah, I'll take Donna as this other guy says.
Yeah.
You can tell there are traders in the room. Like, yes, I'll take someone else's fill.
All right, guys. So I want to thank FT as always for his time to put together the presentation, to answer people's questions, and then of course to autograph these books for guys that have won today. I'll send you an email on BMT after the webinar and get your autograph request and any contact information from you so I can get the books in your hands. And I'd like to see everybody stay tuned for the other webinars for the rest of the month. There's still many, many to come with some really fantastic prizes yet to come. All right, I'll post the recording of this on YouTube sometime tomorrow or early or late tonight. And I just need everybody to give us a thumbs up if you like it. And we'll see FT back here in July. He'll resume his Ask Me Anything series.
Awesome. Right. Thanks so much, Mike. This has been great.
Yep. Thank you very much, FT. It was a great webinar. Bye.
All right. Bye.
The organizer has ended the session, and this call will